In the last class, we were able to explain with illustrations how to treat revaluation of assets in partnership. Now, in this class, we're going to be looking at the dissolution of partnership. Dissolution means bringing partnership business to an end. It's also called liquidation of partnership or cessation of partnership or winding up of partnership. So that is what we are doing in this class. Dissolution of partnership. Dissolution of partnership simply means cessation of partnership. That is, you're bringing the partnership business to an end. So we can say liquidation of partnership, we can say winding up of a partnership business. Now, there are various reasons for dissolution of partnership. What I'm trying to say is for a partnership to come to an end, there can be various reasons responsible for it. So we're looking at some of the reasons for bringing a partnership business to an end. The first one there is death of a partner. If a partner dies, the business or the partnership business is or can be resolved, can be dissolved. The next one is where the partners jointly agree to bring the business to an end. If maybe 3 of them or 4 of them involved, all 4 agreeing to bring it to an end. The next one is conflict that cannot be resolved. Once the partnership business, the partners have conflicts that they can't resolve, they can just decide to bring the business to an end. Bankruptcy of a partner that's unable to pay its debt that can cause the partnership to come to an end. Then you can have notice by a partner to others of his intention to dissolve the partnership. So maybe out of 3 or 4 partners, one person says, look, I want us to bring this business to an end. That can be a reason for dissolution. The next one is insanity of a partner when a partner runs mad. You apparently cannot run a partnership with a mad person. So that can, be a reason for dissolving the partnership. Then another one is conversion of partnership to other form of business. So it is possible that you want to convert the partnership into maybe a limited liability company. So if you are in a partnership with your friends and then there's a decision to convert it to a company, that means the partnership will be dissolved. Then we have illegality of the partnership. So if in the process of running the partnership, there was, an event that led to declaration of the partnership as being illegal, that can be a reason for dissolution. So another thing is where the purpose of the partnership is achieved. So if you have registered partnership business with a friend for a particular purpose, the moment you achieve that purpose, you have to dissolve the partnership. We have amalgamation of 2 or more partnerships. Amalgamation means to bring 2 partnerships to become one. So apparently, if you're trying to bring maybe X and Y together with A and B to form ABXY. So the idea is that X and Y will have to be dissolved, A and B will have to be dissolved before you bring them together. So that can be a reason for dissolution. When a partnership business is dissolved, its assets are sold. So the sales proceeds from the asset has to be distributed in a particular manner. The first thing is to pay debts to third parties. That's external parties that the business is owing. That's the first people that ranks priority. You have to pay them first. After paying them, then you pay loans that partners have given. That is, apart from the capital that the partners give to the business, they also give a loan. If, for instance, you're in partnership with a friend, and apart from your capital contributed, let's say you contribute a capital of 2 million, then you give a loan of 3 million. So in this kind of event, you have to be paid your 3 million first before talking about the capital. So after paying the loan, that partners give to the business, you can now go ahead to pay each partner what is due to them. In closing the books of a partnership business, you prepare a realization account. Basically, the realization account is the account in which you transfer the assets that are to be disposed at their net book value to, and whatever amount that is gotten from disposal is also transferred to the realization account. So basically, the values, okay, of proceed entries from closing the assets and the liabilities of the ledgers, okay, is transferred to this account. Another simple way of explaining realization account is to say it is the account in which the cost of the assets to be sold is compared to the amount received from the assets sold. So you're going to have either profit or loss on realization. So basically, if the proceed from the assets sold is higher than the cost of the assets, there's profit. If the cost of the asset is higher than the proceed from the assets, then there's what? A loss. So the account where you have this is what we call the realization account. So let's go. Look at what it looks like. This is the realization account. Okay. So here it's what? The cost of the asset. Look at it. Land and building, motor vehicle. Okay. Remember, your motor vehicle is an asset. It's at the debit balance. So if you're doing balance brought forward, okay, to the motor vehicle, you want to close the motor vehicle account, you credit the motor vehicle account and then debit what? Realization account. So we have the cash sales proceed. That's this, the sales of the assets now. You credit them. Any discount received, you credit. Dissolution expense, you debit. So at the end, the proceed here in the credit side, you compare it to the what? Item here, the cost here in the what? Debit side. So here, your proceed here is higher than the cost. So you have a profit which you're going to share among the partners. Let's assume A and what? B. Sharing their both profit equally. So you just divide by 2, divide by 2. And that ends what? The realization account. Now we have the asset account or the ledger. So the assets are, the fixed assets and the current assets and other assets in the business. So basically what we have here, the asset accounts are the individual ledger account that make up the balance sheet. Okay. So all assets except cash are transferred to the debit side of the realization account. This is what I'm trying to say. For instance, you have office equipment. This is an asset. This is balance brought down from the balance sheet. Okay. So you want to transfer it to realization account, you have to credit to close the book. So you have realization account credited. Okay. So in the realization account, you have office equipment debited. Okay. So in the cash account now, you know that this realization account here, you have the cost of the asset. Here you have the sales proceed of the asset, which you credited. So this will now be transferred to where? The cash account. So it's double entry. Basically, you credit the what? Asset account, debit what? Realization account for the net book value of the asset. So when you now sell the asset, you credit realization account and debit what? Cash for the what? Money received in selling the assets. Now, the liability account or ledgers are, those individual liability ledger items that make up the balance sheet. What are liabilities? Liabilities are, debts that the business is owing others. So creditors, for instance, is a liability to the business, and creditors, we have to be settled. Okay, so it is also possible that in settling the creditors, you can have discounts. Okay, but basically, here is the creditors ledger. Creditor is what? They have credit balances. Understand your double entry for what? Liability. So you have balance brought down from the trial balance sheet here. So you have to pay them. So you close the account. Remember, I said in utilizing the proceed, you have to pay your what? External parties. So creditors form the external parties. So you close the creditors account by paying them. This is the cash here. You debit creditors to pay them, and then you credit the cash account. Look at it here. But you can have discount on the creditor. For instance, you're owing the creditor, let's say 100,000, and then you pay the creditor 80,000 in full settlement. So the 20,000 is a discount received. Okay, so that one you take to realization account. You credit the realization account. Okay, and then the creditor's account is what is actually debited. So here we have partners capital account. So this is where you have the balance that is due to individual partners after selling the asset items, and then after sharing the profit on the realization. Okay, so basically what we're saying here is this. This is the partner's capital account. Balance brought forth from the balance sheet. Okay, if they have any current account balance, you credit the what the capital account. Then if a partner takes over an asset, let's say vehicle for instance, you debit that what partner with it. Okay, so at the end of the day, you compare the credit of individual partners against their debit. So the credit here is higher than the debit. You have what they call cash balance. Okay, but the share of profit here is that of the what profit on realization. That is when you realize the assets of the business, then there's a profit that was shared. It will be what credited to the partner's capital account. But at the end, basically, whatever balance that is remaining on the partner's capital account is settled in what? Cash to close the book. So here you have the cash account, for instance. This is the balance brought forward. Then you pay the partners, pay partner X, pay partner Y. Your cash account is still the same. You debit when there's inflow, you credit when there's what? Outflow. Then this is a general account now. You have X capital account for motor vehicle taken, credited. And you see that, Y. So Y's capital account for motor vehicle taken. So you can see it here in the realization account, Y's capital account, motor vehicle taken credit. And then the capital account, you have motor vehicle under what? Y. Realization expense or realization expense account can also be called dissolution expense or dissolution expense account. Basically, what we're saying here is expenses incurred in dissolving the business. So you can incur some other expense in the process of selling the business assets. Okay, so whatever expense you incur in the process of bringing the business to an end is what we call realization expense or dissolution expense. So basically, what we do here is to what? Debit the realization account with dissolution expense, and then credit cash account with dissolution what? Expense. So here we have cash or bank account. So after selling all the assets, the money comes into the cash at hand or cash at bank. Then out of the cash at bank, we'll pay the creditors, and then pay whatever expense we want to pay, and also pay the partner. So basically, this is the account in which the utilization of the proceed from the sale of the assets, in paying the partnership liabilities and debt is shown. So basically, you can see this is your cash account. So here you have all the cash inflows, balance brought forward, basically what we have as at the balance sheet date. Then this is the asset, all the monies gotten from selling the assets. And then we'll pay creditors, we'll pay the dissolution expense, then the remaining one will pay the partners. At the end, there's no balance card, and everything must agree, because you're bringing the business to an end. So whatever is remaining should be able to pay the partners, except of course the partners. A partner has a debit balance. That means the partner has to now refund the business in cash. So what I'm saying is, at the end of the dissolution, it is possible that the partner is in debit, so that partner has to refund money to the business, so that other partners can be paid. So I just explained that it is possible for a partner to be in debit. That means the partner is unable to pay its debts. Okay, so it can be agreed that other partners, will wait for this partner that is in debit to refund money to the partnership so that they can be paid. But sometimes it's also possible that the partners that are solvent, takes the debit balance from the partner that is insolvent. So the rule of Ghana versus Moray states that in the event of dissolving a partnership and the partner has a debit balance, that debit balance is expected to be shared among the solvent partners in the ratio of their last capital balance. Okay, this of course is where there is no other agreement, as against how the debit balance should be recouped. So what I'm saying is, where there's no opposing agreement as to how a partner's debit balance should be recouped, where there's no opposing agreement, or where there's no contrary agreement that states that it should be done in a particular way, then what the rule of Ghana versus Moray is saying is that the debit balance should be borne by the solvent partner in their last capital balance ratio. Then the next one is the piecemeal distribution. Basically, here what we're saying is that after selling the assets of the business, okay, it's possible to get the cash at once or get it in different dates. But the idea is that in settling of the partners, you can settle the partners at once, which is also called block settlement, or you settle them bit by bit. So whenever there's this settlement of partners due at dissolution, bit by bit or progressively, we refer to it as piecemeal distribution. In summary, what I'm saying here is that the partnership is being dissolved, the assets are being sold, money is being received, but payment of partners, what they have in the business, is done in bits. That's what we call piecemeal. The rule of Ghana versus Moray states that where there is a debit balance of a partner that cannot pay, that is, the partner is insolvent. The solvent partners, that's the ones that have the ability to still make some payments, will take the debit of the other partner in the ratio of their last capital balance. And that will only happen when there is no opposing agreement. So if the partners have an agreement on how that should be done, then they will follow that agreement. But if there's no agreement on how the debit balance of the partner that cannot pay, okay, should be shared, then you can apply the rule of Ghana versus Moray. So here is an illustration dissolving a particular partnership business. So let's go. We have A and B, who shares profit and losses equally, decide to dissolve their partnership, and the balance sheet as at that date. Okay, so we have statement of financial position as at 31st December 2019. This is their balance sheet. We have land and building 240, motor vehicle 270, office equipment 250. Altogether is 760. They have current asset, cash at bank is 45,000, debtors 75,000, altogether 120. So balance total asset here is 880. Then liabilities here is creditors 320. Partners capital is A and B 290, 270. So 560 plus 320, that's 880. Now they said A, asset we have sold as follows. That means they sold the asset. Land and building was sold for 800,000, motor vehicle was sold for 545,000, and office equipment was sold for 246,000. Then they said creditors we have paid 300,000 in full settlement of their debt. So if you look at creditors here, it's 320,000. Then but we paid 300,000, and that means there's a discount received. So dissolution expenses are money to 52,000. You're required to show the necessary account to dissolve the partnership. So what's the first thing? Show all your asset accounts. Okay, so this is land and building. Okay, balance brought forward is 240,000 from the balance sheet. Look at it here. Remember, assets have debit balance. So balance brought forward is 240. We want to sell it. I want to close the book. So we transfer it to to realization account. So you credit land and building with 240,000 to close it, and then you come and debit realization account. Look at it here, 240,000. The next asset is motor vehicle. Balance brought forward is 270. Look at the question, 270. Balance brought forward. So we want to close the book. So take it to realization. You credit it 270. You debit realization 270. It's double entry basically. The next one is office equipment. Balance brought forward is 250. Look at it in the question, 250,000. We want to close the book, so we'll sell it, take it off to realization. So you credit office equipment 250. Look at it here. You debit realization with 250. Okay. The next one is debtors. Debtors here will pay us cash. Okay. Debtors will pay us cash. So if you want to close debtors, you have balance brought forward 75,000. So cash, you credit debtors to close it. Okay, 75,000. Then in your cash account, look at your cash account. Debtors here is debited 75,000. We'll come back there. So now we have creditors. Balance brought forward here is what? 320,000. Look at it in the question. 320,000. But remember, they said creditors will have paid 300,000 in full settlement of their debt. So that means cash paid to creditors is 300,000. Then what happened to the remaining 20,000? That's discount what's received. So that will go to what? Realization. We have debiting creditors here. So we'll quote credit realization, discount receive 20,000. Now we had sales. Look at it. Assets were sold as follows: land and building 80,000, motor vehicle 545,000, office equipment 246,000. So if you add this 800,000 plus 545,000 plus 246,000, you have 1,591,000. So now you have dissolution expense. Okay, they said dissolution expense is what? 52,000. I said in that case you debit what? Realization account with what? 51,000, and then credit what? Cash, because it will be paid. So by the time you take every item that is to be taken to realization account, you compare your sales proceed with your what? Cost. So here the total sales proceed is 1,611,000. So you minus 240, 270, 250, and 51. Okay. So what's the balance? 800,000. And they say profit and losses are shared what? Equally. So, and there are two partners. Divide by 2. You have A taking 400,000, B taking 400,000. So when you add all, now it gives you 1,611,000, 1,611,000. So the next one now is the partner's capital account. So what's the balance brought forward? That's the partner's capital. Look at the balance sheet. Partner A has 290,000, partner B has 270,000. So you have balance brought forward. Capitals have credit balance. So balance brought forward is credited 290, 270. Okay? No partner is taking over any asset. So the next thing is the share of profit or realization. So what's the share? Look at the account here. A is taking 400,000, B is taking 400,000. So what? You have share of profit and realization 400,000, 400,000. So at the end, this is 690,000. This is what? 670,000. So they expect cash to be paid to them. A should take 690, B should take 670 to close the capital account. So here's the cash account now. What's the balance brought forward? 45,000 is from the question. 45,000. We have balance brought forward, 45,000. Now, realization, that is the amount realized from all the assets sold. Look at the account here. Cash sales, 159, 1,000. So we have realization account here, 159,1,000. Debtors paid us 75,000. Look at your debtor account here. Balance forward, cash, 75,000. So this is the realization. This is what we got now. This is the cash available to what? Distribute. So what? We paid dissolution expense, 51,000. Okay? We pay creditors, 300,000. The remaining balance you're able to settle the partners. We pay partner A 690,000. Confirm. Look at it here. We pay partner B 670,000. Confirm. Look at it here. So at the end, you have zero cash. So debit side is equal to the credit side without any balancing figure. Look at it. 171, 1,000. 171, 1,000. So basically, the cash that we received was able to settle all the expenses. In this class, we were able to look at dissolution of partnership, that is bringing the partnership to an end. We were able to look at the reasons, possible reasons for dissolution, from death of partner to insanity of partner, to joint agreement of partners to bring the business to an end, to amalgamation of partnership, to conversion of partnership to other form of businesses, say limited liability companies, okay, to illegality of the partnership due to what happening or events. We're also able to look at accounting for the dissolution, that is closing the books of the partnership. Okay, we're able to explain what realization account is. We're able to explain the individual asset ledgers. We're able to explain the individual liability ledger. We're able to explain dissolution expense. We're able to explain how to prepare the capital account, and we're also able to explain how to prepare the final cash account. We also briefly looked at the Ghana versus Murray rule, and then we looked at piecemeal distribution based on the syllabus. So basically, this is the dissolution class. Then we looked at illustration on how to prepare the books for dissolving the partnership. So I will encourage you to go through the class. If you have questions, you can reach me on 08136506356 or send me an email, jeremiah.dosu@gmail.com. You can drop questions in the comment section. I'll be there to reply you with the right answers. Thank you.